Thanks so much for tuning into this conversation. It's my absolute pleasure to speak to Aditya Khemka today. The last 2 years, we've done about 3 or 4 conversations wherein he's moved the sphere from being not so constructive to becoming constructive on select pockets of healthcare to now finally seeing some of those uh, uh, pockets starting to perform on the bourses as well. And therefore, uh, it'll be important to understand from him what has he made of the performances, the fundamental performances of these companies over the last 2 quarters, and how does he see the outlook ahead. Aditya, great having you. Thanks for taking the time out.
My pleasure, Niraj. Glad to be back.
So yeah, no, the pleasure is entirely ours, I must say. So Aditya, as we do it every time, we'll break up the bucket into the 3 or 4 buckets of healthcare and start off with and talk about each in a detailed fashion. I want to start off with the basic healthcare pharma companies, US generic exposed and India domestic exposed as well. There has been a notable difference in the performance as well as the commentary from some of these companies. You had spoken to us about how price erosion in the US typically follows a cycle. At some point of time, it reverses and then the performances improve. Are you sensing that period now? And what else would you say you gleaned from the performance in the commentary in the last couple of quarters?
Right. So look, in the unbranded generic pharma side, two things are happening right now. One is obviously your price erosion last year, which was about 12%, 15% on an average, has gone down to 5-6%. But Niraj, please pay attention. This is still price erosion. So when price still erodes, it still hurts your margin, it still hurts your revenue. You still need to add new products to grow, right? Now, what is happening on the other side is that while price erosion has just about come back to the historical average of 5-6%, on the other end of the spectrum, we have one or a couple of large products that have gone generic in US right now, which is Revlimid, one of them. And there are many other small products. Compared to Revlimid, these are not very large products. But because Revlimid has sort of got a settlement where there is no scope for a price war, the scope for price war isn't there. See, normally price wars happen because 5-6 generics that launch together want a large share of the market. And therefore, they compete for the volume share by reducing prices. In Revlimid, the volume share of each player is predetermined. They cannot fight for it. They are allocated a certain share. Now, because they're allocated a certain share, there is no need to engage in a price war. There is no incentive to go on a price war. And that is why Revlimid is creating very, very exciting, very large revenues for all the large pharma companies that have filed Revlimid. Now, what may be happening is some of these large pharma companies, in some cases, the investors might be mistakenly believing that Revlimid revenues are actually base revenues, right? See, Revlimid is a 3-year cash flow. 2026 Revlimid patent goes, and all these players, then becomes a free for all sort of a market, and the price erosion, the volume share, all of that comes back into play. But till 2026, that is not going to be the case. So my fear or my apprehension is that is it possible that some of our investors are believing that the revenue uptick in US generic business is not only because of Revlimid, but also because of the base business. If that is the case, then you are believing that something which is recurring is improving, and that will drive your price performance. But if you are just looking at the headline number of total US generic sales, which includes a large chunk of Revlimid, then your analysis is just incomplete. So I think from a standpoint from where I stand today and the data that I'm looking at, and these are data on price erosion, data on new launches, data on how the other what the American players are saying, what the European players are saying, I don't see any structural improvement in the US generic market. Yes, there are a couple of large product launches, some 6 months, some 1 year, 2 year, 3-year cash flows. But if you value these 6 months, 1 year, 2 year cash flows at 20x, 30x P multiples, you're making a mistake. And as and when these cash flows die down, you'll have to pay for it.
Was this in the price, Aditya, at some point of time in the last preceding 3-4 months, because of which people may have thought that even if their assessment was correct about the nature of the revenue uptick, maybe people thought that this looks attractive enough at this price, let me make the most of it. Maybe not do it as an investment, but as a positional trade, and people got into it, and at some point of time will get off it. So my question is, one, would you not be constructive therefore on this based on what you said?
Yeah.
And two, is the price still baking that in, or is the price now fully capturing the positives that come in from the 2-year, 3-year uptick from Revlimid as well as some bit of that improvement in the margin erosion, although it is still margin erosion?
Correct. Um, I think the price today is capturing the improvement in the US business in terms of reduction of price erosion. And it is capturing Revlimid as a perennial cash flow. So I would not be constructive in majority of these names that have Revlimid as a product. I would like to wait till FY26 when these products, when Revlimid goes off, off patent completely and becomes a free for all. And if then we still have, growth or we still have improvements in margins, that's something to play for, because that would be the base business. But as of today, there is no indication that that is happening.
Okay, got it. The India-focused pharma business, Aditya, I mean, is there stuff to like there? I mean, is the commentary or the performance good, looking promising?
Yes, absolutely. So in the India-based businesses or India-focused pharma companies, we have seen a bunch of companies report fairly good numbers and fairly aggressive margin expansion. And this is simply, what we had thought earlier. So over the last 2 years, China was not able to produce KSMs, and KSMs became dearer. And pharma companies are always afraid of stockouts because when they stock out, patients suffer. So pharma companies always stock up on raw material when they feel that there could be a potential disruption. So most of these branded generics, they stocked up on raw material, which was expensive raw material, and that impacted their gross margins for a very long period of time. And now that China is back in full swing production and the prices are cooling off, these branded generics are coming back and showing better margins because now their raw material prices are also coming down, while the end sales price has gone up because they've taken price increases given the positive WPI last year. And that's what their sales price increases are generally linked to. So they've taken price increases and the raw material costs are cooling off. So you are seeing that double impact on the gross margin where the selling price is up and the raw material cost is down. See, Niraj, you have to, instead of judging these guys, you have to see what has happened to them over the last 2 years, right? So for the last 2 years, their top line has grown at 10% and their EBITDA has fallen at about 5-6% CAGR. Now, the reason for a decline in EBITDA despite growth in top line was largely raw material cost. There were other factors at play, yes, container cost, power cost, there were other factors. But the largest contributor was raw material cost. So now that that cost reverses or the cost normalizes, you will see margin expansion and stocks doing well, and which is what we are noticing right now.
Got it. Before I move on to the other aspects of the healthcare space, Aditya, one more question on pharma, and it's a very wide bucket, of course, now. But there is a lot of chatter on social media, on select articles that are written by experts who speak about some fairly innovative therapeutic use cases that companies are building, either as suppliers, in very select few cases, maybe even as innovators, so on and so forth, futuristic treatments, all of which could actually give a tremendous use case, profitability, moats to some of these companies. Now, I admit I'm not that knowledgeable enough to be able to question you on each of those individually. So therefore, my request to you would be that I'm making an open-ended question to you to tell me what pockets within this pharmaceutical manufacturing companies are looking interesting from a futuristic perspective, where you have an eye for, even if you don't have an investment. If you have an investment, then even that.
Yeah. No, so we don't have any investments in such companies which are doing innovation. And at a very motherhood level, I mean, the reason why we don't invest in companies that are investing heavily in innovation is because innovation in pharma has like a 5% success rate. So from an investor standpoint, it doesn't make sense for us to invest, or you go with a very large bucket, diversify yourself. And you know that 10 out of the 15 bets will not go right, but 5 bets will go right and they will pay you off for your entire 15 bets. But we don't have such a big universe to invest in today in India. We have a handful of companies, you can count them on your fingertips, that are meaningfully investing in innovation. But Niraj, innovation is a multi-decadal effort. Sometimes, if luck favors you, you can get it right in 5 years, 6 years, 10 years. But if luck doesn't favor you, so let's take some names. Glenmark Pharma, for instance, I know for a fact they have been in innovation since 1990, and it's 2023, and they haven't seen a success. Wockhardt has been in innovation for 2 decades, no success. Spark has been in innovation for a very long time, but no material success. So that's the whole point, right? So it's a game where it makes sense for the promoter because the promoter is in it for the really long term, right? We as shareholders, public shareholders, our horizon sometimes may not be as long, and we as fund managers, the money that is given to us to manage, those clients don't have that kind of like 30-40 year sort of a horizon that we can invest in such names. Having said that, I mean, it would be a day of great celebration and pride if someday an Indian company of the all the companies that we mentioned and many more that we didn't mention, if they come up with an innovative therapy, because that will really flag us off as one of the innovators of the world. Today, that title lies only with American, European, and Japanese by and large. And to join that elite league will be a great achievement. So we look forward to it.
So anything in the in the pharma, pure play pharma companies, it could be API, it could be this, it could be that, but anything in that universe beyond the India specific companies that you spoke about that you're constructive on before we move on to healthcare otherwise?
Sure. So we are constructive on companies which are focused either on India and if not just India, then India and emerging markets. Remember, most of the emerging markets are also branded generic markets. So your Northern Africa, Middle East Asia, Southeast Asia, Latin America. So these are all branded. So we are bullish on branded. India is just a representation of branded. Second, we are bullish on certain API players, and these API basically raw materials. So people who make these raw materials for the innovators, because the innovators, they look at themselves as more branding and research companies. So they want to outsource manufacturing and late stage research to third party because they don't want to engage in that. And companies like Syngene, Newlin, Heikel, these are all players who are supporting innovators in that effort of outsourcing to other countries. So we are bullish on that bucket as well. That has a China plus one element to it as well. But these companies also do the generic API business, which is something we are not again very bullish on, because if the end customer, which is a Sun Pharma or Dr. Reddy in the US, is under pressure, then you will also be under pressure. He'll not let you make decent margins. But because we don't have a pure play innovator API to play on, we selectively choose those companies for whom innovator API is a larger portion of their future growth than the generic API.
Okay, and most of these companies, Aditya, the ones that you spoke about and even otherwise, I think not only performed decently well in the quarter or maybe even the previous one, but their commentary around growth seems to be fairly promising.
Yeah, it is promising. And look, it's very clear. So China basically, frog leaped us when it came to contract research and manufacturing for innovators also, right? And China, there's a company called Wuxi AppTech in China. It's one of the largest contract manufacturers in the world, and is still growing at 35-37% top line. So you can imagine the kind of opportunity that exists there. But with the China plus one sentiment now coming in time, I think, and this is just my opinion and my belief, I think the West is looking at Russia and saying, look, if Russia can weaponize gas, why can't any other geography weaponize medicine, right? So now the Western world is thinking, should we be relying on one partner, one country, one geography for a source of something which can be weaponized? And I think that is where the diversification from China to India just makes a lot of sense. Just makes a lot of strategic sense. It may not make cost sense. So we are still probably a little bit more expensive than China. But strategically, it's important for them to not rely on one. And which is why most of these companies that we spoke of, they are doing capex, they are getting more orders, the order book is swelling up, they're getting funding for this capex. So these companies tell us that the customer who's giving us the order is also giving us an advance to set up the facility in which we will produce their product. So you can imagine the kind of partnership these big pharma companies are willing to do just to secure their future. And that just makes sense. If this were me and you, we would do the same thing. So it just makes strategic sense.
Lovely insight. Thanks for that, Aditya. I mean, this is golden stuff. Okay, now let's move on to some of the other buckets around healthcare. And I remember you said, Niraj, round one belongs to you when it comes to diagnostics. I knew very well that I didn't want to enter into a bout with you, but because I knew that the future rounds might belong to you because you're well informed there is some bit of price traction as well that is coming. But the price notwithstanding, the performance traction selectively in some of the buckets is done well. Though, yes, Thyrocare has kind of been neither here nor there, if you will, but some of the others have performed really well. Now, reasonably well, let me put it that way. How do you see what's happening in this? Is this now a return to normalcy for the diagnostic businesses?
Yeah, I think it is broadly a return to normalcy, simply because I think the online discounted players have raised prices. Look, in the earlier 2 years back, right, the cost of money was literally zero because the interest rates were zero. So, these funds gave money to these startups and who not, and they said, look, burn capital as much as you want, but get me market share, get me revenue. Now that the cost of money suddenly zoomed up, people are talking about ROC, profits, cash flows. And when these same startups want to look at ROC, cash flows, and profits, they have to look at prices at which they sell their services. And that is essentially why these startups are also now increasing prices. Now, if you think of it, the only advantage or the only reason why the consumer in the first place was willing to go with the startup was because of the price discount that they were giving compared to the conventional business model, so brick and mortar business model. The conventional business models always had the consumer trust, but they had higher prices than the discounted prices which the startups were giving. Now with the startups raising prices, it's basically the consumer is saying, look, why you? Why should I come to you? And I can go back to my original supplier. And I think that's what we're seeing somewhat. Also, the market is expanding meaningfully, Niraj. I think the startups, what they have done is they have at least increased the awareness around diagnostics. And because it is app-based, whereas the historical model of the brick and mortar guys was collection center based. So now the reach has expanded. And now these brick and mortar guys are coming with their apps, right? And that will help them to connect to the guys who got sensitized by the discounted players. So it's sort of the ecosystem itself is sort of stabilizing, it's growing. The market itself is growing. You mentioned ThyroCare, right? So ThyroCare, obviously top line growth at the surface looks 4-5%, but for their recurring business, which is their core business, the franchisee business, their growth was 14%. They lost a government tender to another diagnostic player called Krishna. And because they lost that tender, that part of the business degrew. And that is why the console growth doesn't look very impressive. But Krishna, which won that tender, reported 24% top line growth. So, these things will happen. One player will lose a tender, the another will win. The point is that the market itself is now double digit sort of a growth market, it seems, and which is what we had anticipated. And we feel that, yeah, this is just business as usual. This will just continue to grow.
Got it. And I take it that from whatever little I understand from our previous conversations, that you're still constructive on
Absolutely.
on the diagnostic players, yes, but also on the hospital chains, because that was a bucket that you were constructive back
Absolutely.
then.
So on the hospital side, it's very clear for us that it's a business where the bargaining power of the service provider is far superior than the bargaining power of the service consumer, right? So I often say this on multiple platforms that people compare hotels and hospitals, and people say that hotels give room on rent, hospital gives room on rent. So what's the big deal? And we say that, look, when you go to a hotel, you decide how many nights you stay, what food you eat, whether you buy at the gift shop. When you go to a hospital, all these decisions are made for you. You just need to pay, right? So the business model itself is a very, very good business model. We really think that it's a business which will last for the ages. And it's a business which is extremely profitable, cash flow rich business if managed properly. Obviously, there are managements which can screw it up, but we generally go with managements which have a track record of managing it properly. And there we feel that there's a lot of money to be made for investors in the next decade or so.
Yeah. I was talking to another private equity fund, Quadria Capital, and the gentleman out there said, and I was quizzing him, and I would love to know your view, Aditya, on this. I was quizzing about the fact that, for example, in Mumbai, when we have done these treatments, we follow the doctor to the hospital, even if the hospital is not a part of a chain. And therefore, is there merit or is there future benefit in a chain getting that recognition and the valuation simply because people follow doctors? And his view was that at some point of time this will happen, even if it's not happened thus far, and that Bombay was an idiosyncratic market. The rest of the country may not be the same. I would love to understand from you, Aditya. There's some chains getting developed. What is your view there?
So look, within the hospital ecosystem, there are two elements. There is the hospital brand and there is a doctor brand. Now, historically, and so far, I would say still the majority of the patients are sourced by the doctors. Very few patients actually walk into an Apollo because it is an Apollo, or walk into a Fortis because it is a Fortis. They walk into an Apollo because the doctor they know has referred them to it, or a doctor they know will operate on them in Apollo. Majority of the situation that is the case. And that reflects in the fact that when you speak to these hospitals, they tell you that a part of their income goes to compensating these doctors, and a significant part of their income goes to compensating these doctors, because not only are they lead generators, they're also the people who perform the surgery and take care of the patient post-discharge, so on and so forth. So there is a partnership clearly there. Now, who has the upper hand? Historically, the doctor has had the upper hand in this business model because he sources, he manages, and post discharge also he's a sort of a AMC provider, if you may think of it that way. Now, what is changing slowly, and this will be a very gradual change, the hospitals themselves have stopped sort of believing in this star doctor thing, where look, there are certain hospitals which were based on a couple of doctors that joined the hospital, right? So I don't want to name any of them, but you might think of a couple of names where the hospital chain is based on the reputation of a doctor, right? And then what happens is that the doctor leaves. The hospital doesn't know what to do, how to get patients, and how to operate. So most conglomerate hospital chains now, or large hospital chains now, they've come to realize that this cannot be a sustainable model. So therefore, they are now relying more and more on branding the hospital, making the patient aware that Apollo does this, Apollo does that, Apollo, or Fortis does it, Fortis does that, Fortis. I'm just taking examples. But the fact is that these hospitals are now trying to put their brand name ahead of the doctor brand. And it is not going to happen overnight. It is a long process, because what we have lived with is for decades. So it may take a couple of decades to change it. But with every incremental percentage shift from the doctor to the hospital in terms of the patient flow, the bargaining power will keep slowly changing from the doctor to the hospital. And that will further improve. So today, whatever profitability or cash flow we see at the hospital is with the existing bargaining power, right? So if they gain more bargaining power versus the doctors, who are their partners essentially in the business, then the profitability will also see a step up.
Got it. Aditya, before we let you go, I'll ask you a few questions. I'm sure there are many that I've missed. So I would love to understand from you, from over the last 3 months, from stuff that you've read, the stuff that you've thought was worth pondering an investment over. What is it that has stood out the most for you in terms of recent trends or future trends? Can you just give us some sense there?
Sure. So one trend which has obviously stood out is the margin expansion, as we spoke of, because raw material cost has come off, and that is reflecting in API players, branded generic players, to an extent in the unbranded players also, because they also import the same material from China. The other thing is, which was recently happened, is this NMC regulation, National Medical Commission regulation, where they have put out a guidance saying that all doctors need to prescribe generics only, apparently. And it is doing a lot of rounds in media, and there's a lot of backlash that they've gotten from multiple doctor associations. That doctor association is saying you can't allow us to do only generics because you don't have a quality standard, and you have no. So for us, brands represent quality, not really brands. So this is something which I think is worrying many investors who want to invest in healthcare. But I think from your medium, or from my reading from the industry, is that that they are not worried about this. They are saying that this cannot stand on its two legs. It is getting challenged in the court. It is getting protested against the associations, and there will be some meaningful watering down of this regulation, because this regulation doesn't help anybody. If you look at the unbranded generic markets of the world, they are the most expensive generic markets: US, UK, Western Europe, Japan, China. So the notion that unbranded generics are cheap is just flawed. It is not backed by data. Today, unbranded generics are cheap versus the branded generics because they want a foot in the door. Right? The moment you give them the podium, they'll exercise their bargaining power, and you'll be helpless. How many times will you change a national regulation, right? So I don't think it has been well thought through, the regulation, and I think obviously the industry is giving them a lot of feedback. So I'm hoping that we'll see some conclusion on that regulation side in the next couple of months. But that's not impacting stock prices, and that's not impacting business. It continues to be as usual. But that's something I thought it was worth talking about.
Most certainly, very much so. Aditya, always a pleasure talking to you. Thank you for taking the time out and talking to us today as well. And maybe talk to you once more before the end of the year.
Sure, let's do that. Thank you.
Thank you. And viewers, thanks for tuning in.